The first story of the day is Apple announces largest ever $110 billion share buyback as iPhone sales drop by 10%. And it's just a casual headline here on May 2nd, 2024. But let's look into this as it is the largest single share buyback in world history. It's the largest buyback in history, ahead of Apple's previous repurchases, according to Briani Associates. Let's analyze this for 1 second. Let me look you right in the eyes. Let's talk about this. Why are share buybacks a thing? Apple just spent this $110 billion that could have been spent on increasing their manufacturing, paying their laborers more. But no, they needed to juice their quarterly earnings report because Apple, hey, our iPhone, our sales dropped 10%. And guess what? In our current iteration of our economy, things go quarter to quarter to quarter. So instead of using those $110 billion on you buying something productive, hey, guess what? We need stock buybacks. And you know what? This is not a phenomena that's in nature. For most of the 20th century, stock buybacks were deemed illegal because they were thought to be a form of stock market manipulation. Oh, you think? But since 1982, when they were essentially legalized by the SEC, buybacks have become perhaps the most popular financial engineering tool in the C-suite tool shed. So let's analyze what we can do with $110 billion. So, I know Apple being a private company and all, but I think it's important to recognize the figures that we're talking about here, the massiveness of this number. Because with $11 billion to $30 billion a year, we could essentially end homelessness. There's a figure from Psychoanalysis that said, there should be cheaper ways to house people than simply paying the median rent. But these figures suggest that on the high end, eliminating homelessness in the United States should cost anywhere from $11 billion to $30 billion a year. Recognize how the economy works. Apple spends $110 billion to juice their quarterly earnings numbers, and that's where the money in the economy goes. Not the $11 to $30 billion a year it would take to pay the median rent cost to end homelessness. So let's understand this here. Our economy is based off of these financial markets that are fake. But the money is real. So now, Apple shares have climbed 7% in extended trading on Thursday, May 2nd, after the iPhone maker reported fiscal second quarter earnings that topped estimates and announced its extended stock buyback program. Guys, they're doing this to juice their quarterly earnings numbers. This is how the logic works here. Okay? You have 100 million shares outstanding, they're each worth $100. You buy 10 million of those shares, suddenly there's 90 million of them, but those 90 million of them have to be worth the entire business. So your earning per share number increases. Okay? Let's watch how CNBC covers this historic, monumental collapse of the free market in the American economy. Let's see how they talk about this.
Hey there, John. Yeah, and it's a beat on the top and bottom line for Apple, plus the largest buyback in corporate history. Let me go over the numbers first. EPS is a beat here at $1.53. Street was looking for $1.50. Revenue, a slight beat, $90.75 billion versus the $90.01 billion expected. And then as for that buyback, $110 billion. Like I said, that's the largest ever announced. That's according to Birani Associates. And then
Hey, remember, last year they did $90 billion. Again, how much would it cost to end homelessness? $11 billion to $30 billion a year. Apple to juice its quarterly earnings number, to juice its stock price so that they can get richer and their investors can get richer and this whole shareholder capitalism thing can just go on as kicking, could have ended homelessness.
Dividend is increasing to 25 cents a share. And just a couple little segment revenues here. Let's go over iPhone. A slight miss of expectations at $45.96 billion. That's down better than 10% year over year. And then services, a slight beat here, 23.
These guys cover this like it's a horse race. Hey, some people are gambling on the race and this and this, and it's minute by minute, and we're trading, we're making money. We're talking about the amount of money that can change economies, and it's kind of covered as a sort of spectacle horse race and this is just kind of what happens rather than the monumental failure of our economic system. It makes it normalized. This makes this incredible dislocation of producing actual tangible economic products and the financial economy. This makes it seem normal. The way this guy's talking about it. It's just a horse race. It's just sports. We're just talking about sports here. It's not sports. It's not sports.
Billion. That's up nearly 14%. And then as for China, I know that's a big question going to here. Sales in Greater China down 8%. We see shares reacting here about up 3% or so after hours, Sean.
All right, Steve.
Shit does not need to be this way. We've constructed our economy based off of quarterly earnings reports and minute by minute and billions and billions and billions of dollars, enough to end homelessness every single year. Again, I'm going to keep on mentioning that, are done to manipulate the stock price so that the investors can get rich. Understand that that's where money, actual dollars and cents are being made. Actual dollars and cents are being made. Understand that that's where it's going to. So it does not need to be that way. We've structured our economy and we've allowed things like stock buybacks. Again, stock buybacks were not legal until the 1980s. Okay? This is not in the law of nature. They should not be allowed to do this. This should be regulated out of existence. And I have many other ideas on how the stock market should work and how financing should work, and we can talk all about those. But what the hell is happening here is so wrong.
Come back to you when you have more. Amit, down 8%, but beat across the board, it sounds like. Is that good enough?
I think, listen, down 8 is much better than what they did last quarter, right? It was down 12, 13. So I'll tell you.
Down 8? No, but last quarter was down 12, 13. And so now we're going to, it's outperforming our expectations. And based off of our expectations, the stock price increases. These guys make their living doing this because there are billions of dollars on the line doing the horse race. This guy here makes his living just analyzing this, right? He doesn't do anything. He doesn't provide for the economy. The man is not building anything. They're not selling anything. It's all the horse race. It's all sports. He's dropping figures like they're dimes. But again, no one here mentioning that this is not a normal business practice. This is financial engineering.
Ambitious with how they're investing in it.
Plus, Angelo, Apple's peers are going to be paying them to get their AI out there, right?
Yeah, I mean, you would think so. I mean, and I think the comment was just made, great in terms of, the CapEx landscape out there. You kind of look at some of the capital intensity numbers out there for, some of the other Mag 7 names, whether it be, a Meta out there, which is closer to 25%, or, some.
These people love to throw out terms like CapEx and Mag 9. All right. They love to do this because it gatekeeps this industry from everybody else. Capital expenditures, CapEx. CapEx, or capital expenditure, is the money a company spends to buy, maintain, or improve its fixed assets, such as buildings, vehicles, equipment, or land. He could have said capital expenditures to buy or maintain and improve fixed assets, but instead they speak in this jargon. Okay, so this is capital expenditures to improve its fixed assets. Okay, so let's go back. What is he actually saying?
Numbers out there for some of the other Mag 7 names, whether it be a Meta out there which is closer to 25%, or some of these cloud players in the mid-teens or so. It's really interesting when you look at Apple's capital intensity ratio, closer to about 3 to 4%. So
again, capital intensity ratio. Capital intensity ratio is total average assets divided by revenue. So simply put, the capital intensity ratio is the amount of spending required per dollar of revenue generated. So average assets divided by revenue. So you're saying this is our bulk of our assets. This is how much we had to spend, and this is how much money we actually made. Okay.
Teens or so. It's really interesting when you look at Apple's capital intensity ratio, closer to about 3 to 4%. So they don't need to kind of spend aggressively in terms of to get this AI story right, and that's kind of part of the thesis.
So what he's saying is they don't need to spend extensively. So they don't actually need to buy fixed assets to make their revenue. That's basically what he's saying.
As far as Apple is concerned, and the trajectory here of their free cash flow generation long term. And speaking of,
in the projection of its free cash flow generation long term, here's another buzzword. All right. Free cash flow is the money a company has left over after paying its operating expenses and its capital expenditures. The more free cash flow a company has, the more it can allocate to dividends, paying down debt, and growth opportunities. So free cash flow to firm is net operating profit after taxes minus investment during the period. So understand that let's go back. Now that we explained the buzzword, let's go back.
As far as Apple is concerned, and the trajectory here of their free cash flow generation long term. And speaking of just kind of
did he even say anything there? He just said projection of the free cash flow long term. What projection? Is it going to be better or worse?
3 to 4%. So they don't need to kind of spend aggressively in terms of to get this AI story right, and that's kind of part of the thesis as far as Apple is concerned, and the trajectory here of their free cash flow generation long term. And speaking of just kind of
okay, so he's saying because they don't need to spend extensively, they're going to have higher free cash flow which means that they can engage in stock buybacks. Ooh, good for investors.
Free cash flow. I think that $110 billion really I'm really excited about that. I think that
he's really excited about it, folks. There it is. He's really excited about it. No shit. He's excited about it. $110 billion, and the investors are excited about it. Oh my God, no way. Wow. You didn't know that free buying of $110 billion worth of stock would be good for stock price? Jesus Christ.
That's kind of a table pounder as far as what Apple is throwing out there and kind of their conviction level long term about their business prospects.
Yeah, look at something like this. Apple posted $81.8 billion in revenue during a year ago during June quarter, and the analysts were looking for a forecast of $83.23 billion. This is like horse trading. It's not useful for economic production for us to care about if Apple produced $81.8 billion or $83.23 billion. Are they making a profit? Are they able to pay their employees? Are they able to pay their contractors, et cetera, et cetera? That's what's important to the actual economy. What's important to the horse race is estimates versus reality. The economy is fundamentally broken.